Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. The Australian dollar is one of the best performing currencies in recent trade, so I spoke to Katrina Ell at Moody's Analytics to find out whether or not the eco factors are supporting Aussie dollar performance and how long this upward spark may continue. Katrina Ell, many thanks for taking the time to chat with Dukascopy TV. Always a pleasure to receive you.
Thank you for having me again.
No problem at all. Okay, so let's start on some of the eco data that we saw last week. Unemployment moved back down to 6.2%. Is there that propensity still for the unemployment rate to shift higher, or are we likely to see further easing now?
We're actually expecting to see the unemployment rate probably stabilise around its current level at 6.2% because we've got a lot of moving parts happening at the moment. On the one hand, we've got the large service states like New South Wales and Victoria improving, but that's not quite enough yet to offset the labour shedding that's happening in the mining states at the moment. So 6.2% is where we're going to see it remain at until 2016.
Now, the Australian dollar has certainly been one of the better performing currencies in the recent days. We're seeing in the short term a potential upward lift in sort of the days up to the US Federal Reserve, but over the long term, markets still has that negative outlook. Does this match with sort of your views for the currency moving forwards?
It does. We're expecting that the Australian dollar is probably going to depreciate about another 3% against the greenback heading into 2016. So that'll bring it to around 68, 67 US cents. And that's really based on commodity prices remaining low, particularly iron ore, as well as Federal Reserve getting monetary policy normalisation underway, and that's putting upward strength on the US dollar.
Coming up this week, we are going to be receiving the RBA bulletin. What are some of the key trends or themes that you're expecting to come out of this?
We're expecting house prices will have another strong showing in the bulletin, and that'll probably be around the RBA maybe patting their backs, seeing that house prices, particularly in Sydney, have come off the boil a little bit, and we're not really sure exactly the driving force. It's probably a combination of earlier regulatory action, limiting investor participation in the housing market, as well as house prices becoming very strong, and that's affected affordability, so that's lowered demand as well.
I just wanted to do a little cross-check with the RBNZ at the moment. Last week they acted to cut rates for the third time in 3 months. The RBA obviously is on hold now for some time, possibly till early 2016, while the RBNZ is certainly in that easing bias mode. Are we likely to see sort of the rate differentials for these countries moving closer together at some point in the longer term?
It does seem likely. I mean, the New Zealand economy is really struggling at the moment, particularly on the back of low dairy prices. So we're expecting that we're going to see at least one more rate cut, bringing the official cash rate to 2.5%, and another cash rate cut could occur this year, bringing it to 2.25%, which is in line, basically in the near term, with the RBA's cash rate, which is sitting about 2%.
Katrina, thanks for the update.
Thank you.
Always a pleasure to receive Katrina's comments. Do stay tuned, as the Dukascopy TV team will be bringing you plenty more FX insights and analysis. For now though, it is goodbye from me.